Member Huizenga, and members of the subcommittee. Thank you for inviting me this afternoon to share my views on the different ways that private companies have been choosing to go public outside of the traditional IPO process. My testimony today will focus in particular on the rise of SPACs. Over $100 billion have been issued so far this year, or nearly 10 times the total that we saw in 2018. This exponential growth is concerning because SPACs historically have performed very poorly for retail investors, all while the issuers, advisors, and a select group of institutional investors will still profit. The SPAC surge appears to be driven in part by private companies' desire to exploit the perceived speed, a higher streamlined disclosures, reduce liability, and reduce shareholder rights that are offered by the SPAC process. So although many SPACs have although many have just started hearing about SPACs recently, SPACs are really far from new. In fact, they actually date back to the 1980s when they were actually called blank check companies, and they were often associated with scams, and in the process, bilking unsuspecting investors out of millions of dollars. And so fraud was, in fact, so pervasive in these blank check companies that Congress, back in 1990, had to pass the Penny Stock Reform Act to address some of these problems. The SEC followed shortly thereafter with Rule 419 that also dictated blank check company rules. Blank check company issuers, though, decided that they would get around these rules and devised this modern-day SPAC structure, reminding us that properly regulating new assets requires both continuing attention and action. And there are two main ways that SPACs escape from coverage from both the PRSA and also Rule 419. The first is this arbitrary $4 a share threshold that defines a penny stock. And second, the extremely low standard of $5 million in net tangible assets. Neither of those conditions end up applying to SPACs because everyone holds more than $5 million in cash, and they are deliberately issued at $10 a share to get around that $4 mark. SPACs also rely on a safe harbor from being held accountable for forward-looking statements under the Private Securities Litigation Reform Act of 1995. Whereas in an IPO, issuers and underwriters are liable for making false and misleading forward-looking statements, SPACs are not subject to that same standard. That has emboldened many pre-revenue companies in highly speculative industries such as electric vehicles, cryptocurrency, and space exploration to use what we could generously call rosy projections. Take, for example, 9 electric vehicle companies that have come public through a SPAC in 2020. Their combined annual revenue was $139 million that year. But between them, they project to investors that by 2024, they will generate $26 billion in annual revenue. Or let's take a look at a space exploration company, Holicity, who is proposing a merger with Astra Space. They have disclosed to investors, for example, that they have not launched any rockets. Yet, by 2025, they project that they will have daily rocket launches. What's most concerning is that retail investors are buying into this type of hype and in some instances pouring a significant portion of their savings into certain SPACs when the data continues to show time and time again that they perform poorly over the medium and long run. A large part of that underperformance comes from the sizable upfront compensation that goes to the sponsor, who receives that 20% promote regardless of the quality of the acquisition. So as a result, when you look at the average SPAC that is issued at $10 a share, after you pay the sponsor and you meet the redemptions of the shareholders who want to cash out, that SPAC only ends up with $6.67 in cash after the merger. Or put another way, that would mean that the value of the company would need to rise 50% just to get back to that $10. And that leaves many of the retail investors who hold this post-merger SPAC at a significant disadvantage. Now, we wouldn't want people's 401ks to be used at the blackjack table given how the game is mathematically stacked against them. But unfortunately, investing in SPACs in their current form is not too different. And I'll add my remarks with these figures that show just how clearly the house always wins. The average SPAC sponsor between 2019 and 2021 saw returns of 958%. The average institutional investor who is doing this arbitrage trade, which I can later elaborate on, averages a 40% return. But now retail investors who chase these SPACs with the high hopes are losing. And so if we look at between 2010 and 2018, the average one-year return of SPACs following a merger was negative 15.6%. Even more recently, Goldman Sachs found that 200 SPACs in April lost around 17% compared to a 10% return. Given these dramatically misaligned incentives that characterize these deals and their extremely poor performance, we urge the committee to take action. We urge you to amend the Exchange Act to align the rules that govern forward-looking projections in SPACs with those of IPOs, and to broaden the definition of blank check companies to better protect Main Street investors. I thank you for your time, and I look forward to answering your questions.
Thank you, Professor Rodriguez.